Is it better to invest your savings, or should you focus all your attention in paying off your debts first? This is a question that many of us have faced, and the answer doesn't come easy. First, let's explore what is meant by investing and paying off debt. Investing typically means putting money into a variety of assets, such as stocks, bonds, mutual funds, real estate, and businesses, with the goal of earning a return. On the other hand, paying off debt is exactly as it sounds. You use all available funds to pay off any outstanding debts, such as student loans, car loans, or credit cards. Finance influencers such as Dave Ramsey have championed the idea of paying down debt as the best way to achieve wealth. However, there are others who insist that putting your money to work by investing is a much better route. So which one is truly the right approach? In today's video, we will be answering this question. But before we start, make sure you like this video and subscribe to our channel for more awesome content. The truth is, building a strong financial base should be your number one priority before you reconsider either of these options. You need to make sure that you have enough cash set aside for a rainy day. Emergencies happen, and if you don't have any money saved up, you could be left vulnerable. After all, it's never wise to put yourself in a situation where you're borrowing from Peter just so you can pay Paul. Imagine a situation where you're either investing your savings or paying off your debt, and a financial emergency strikes you. You look at your cash savings, but there's nothing there because you've either invested it or used it all to pay off debt. This can lead to a very serious financial problem, where you end up liquidating your investments or taking on more debt to fund your financial emergency. That being said, when it comes to choosing between investing or paying off debt, the decision depends on two key factors: your risk tolerance and the interest rate you're currently paying on your debts. If you have high-interest debt, then it makes more sense to pay it off first before investing, because any return you earn from investments will likely not match up with what you're paying in interest. Have a look at this graph, for example. The average credit card interest rate is 22.37%. On the other hand, the average rate of return in the stock market has been around 10% at best for the last 100 years. This means that if you have debt with interest rates higher than 10%, it makes perfect sense to pay off your debt first before investing. This is because the amount of interest you're accruing from these high-interest debts is going to significantly exceed any return you'd get from investing. However, if you have low-interest debt, like student loan payments or a mortgage, using extra money for investing might make more sense in the long run. There are many good reasons to pay down high-interest debts, but perhaps the most compelling is how significantly it can impact your credit score. That three-digit number holds a great deal of power in today's world and can determine whether or not you're approved for large purchases, such as a car or house loan. It can also affect the amount of interest that you'll be required to pay for your loans. A poor credit score is not only indicative of having too much debt, but also of an inability to handle financial responsibility. This assessment can follow you throughout life, potentially resulting in higher insurance premiums and even making it harder for you to be approved to rent a property. It really pays to understand how crucial having a good credit score is before making any financial decisions which might adversely affect it. If you want to improve your credit score, the first step should always be reducing any outstanding debts by as much as possible. Doing so will instantly eliminate some of the risk associated with lending money and demonstrate that you are reliable when it comes to your finances. As well as making sure that all bills are paid on time, make sure that balances don't get too close to the maximum available limit on each card. This type of behavior leads lenders to believe that the borrower is struggling financially and therefore could become unable to repay what they owe at any given moment. If you've got some spare money and you've decided to use it to tackle your debts, the obvious question is, how do you go about it? If you're fortunate enough to have enough cash to cover everything that's owed, the answer is fairly straightforward. Just pay it off. On the other hand, if there isn't quite enough money in the bank account, then you'll need to come up with a plan of attack. The most effective way of getting out of debt quickly is by taking care of debts with the highest interest rates first and working your way down. To give an example, if you have two credit cards with balances that accrue interest at different rates, say one is charging 20% while the other has 15%, then it makes sense to prioritize paying off the 20% card first. This will reduce your overall debt burden faster than trying to pay off both balances at once. You can also take advantage of debt consolidation loans. This is basically when you take out another loan at a lower interest rate and then use that money to pay off your high interest rate loan. With this newfound freedom comes more cash flow, which can then be used towards paying off that single loan until it's completely cleared. For example, if you had a $20,000 loan with an interest rate of 25%, you would be paying $1,900.88 every month for an entire year. However, if you had a $20,000 loan with an interest rate of only 12%, your payments would drop to $1,776.98 per month. Now, I know this doesn't seem like much, right? I mean, can saving an extra $123.90 really make a difference? Well, the answer is yes. Over the course of a year, that would come out to $1,486.80. If you use these savings to pay down your loan, you could become debt-free a lot sooner without having to increase your payments from your income. Now, let's look into the second option, which is investing your money instead of paying off debt. Investing your savings is a crucial part of building wealth over time. It also helps you protect yourself against inflation, because the value of cash held in a bank account generally decreases as time passes due to inflation, while investments such as stocks and bonds have the potential to increase in value over time. As prices rise, investments tend to keep pace with inflation and even outpace it at times, helping you maintain or grow your purchasing power. Let's look at two different scenarios. In scenario 1, you have a total debt of $96,000, which is the average debt held by everyday Americans according to Experian. In scenario 2, you decide to invest $96,000 into a portfolio of dividend stocks with an annual rate of return of around 6%. In scenario 1, your goal is simply to meet your minimum repayments in order to avoid penalties, and then work towards paying off your debt with your additional savings of $1,000 each month. Based on this, it will take you roughly 6 to 8 years of sacrificing your additional savings each month to become debt-free. In scenario 2, you invest your $96,000 with an annual return of 6%. If you keep adding an additional $1,000 of savings each month, then at the end of 8 years, you will have a total of $275,000. This amount includes your initial investment of $96,000, your additional investment of $1,000 per month, which will equal $96,000 at the end of 8 years, and your investment returns, which would be $83,000. So if you do nothing but pay off your debt for 8 years, you lose out by almost $179,000. This is, of course, a very simple example that doesn't take into account tax, inflation, and other factors like a market downturn. But this is enough to stress the importance of investing your savings to build wealth over time. Lastly, when it comes to making financial decisions, the psychology of the situation is often just as important as the numbers themselves. In the case of debt repayment versus investing, it's essential to consider how your thoughts and feelings are affecting your decision-making process. If you're feeling overwhelmed and anxious about how much debt you've accrued, then repaying that debt should be your primary focus to maintain peace of mind. While investing may yield a greater return on your money in the long term, reducing or eliminating your debts should always be weighted more heavily than any potential profits from an investment. This is because some people can handle financial stress a lot better than others. You don't want to sacrifice your health just for a potentially greater return on your money. So, to answer the question, is it better to pay off debt or invest your money? Well, it entirely depends on your circumstances. That being said, it's also important to remember that debt repayment is only one part of a larger financial plan. Maintaining a balance between making regular payments towards debts and setting aside funds for investments is essential for ensuring long-term financial stability and security. Taking an honest look at where you currently stand financially can help put this balance into perspective. If you have high-interest debt with no end in sight or little savings set aside for investing, then it's clear that paying down those debts should be a priority. On the other hand, if you have manageable debt and adequate savings, then shifting some of your finances towards investments could be beneficial in helping you reach your longer-term goals. Ultimately, having an understanding of both your psychology and finances can help equip you with all the information necessary to make confident decisions when it comes to choosing between investing or paying down debt. What do you think? Would you prefer to pay down debt first, or would you rather invest your money? Let us know in the comment section below. As always, I hope you enjoyed today's video, and I'll see you in the next one.